Hi accounting class, it's another great day to do accounting. Today we're here in chapter 25, capital investment analysis. First going to start off about the nature of capital investment analysis. So this capital investment analysis is used to evaluate long-term investments. So long-term, definitely more than a year, but sometimes 5, 10, 20, 30 years in the future. Sometimes called capital budgeting, but it's the process by which management plans, evaluates, and controls investments in fixed assets. It's very important that the projects earn a reasonable rate of return. And since there's such large funds involved with these capital investments, that they're some of the more important decisions that management makes. We invest a lot of money and we expect a big rate of return, or we don't do so well. Alright, so we're going to look at 4 methods in this chapter. The first 2 are methods that do not use present value, and that's going to be a major weakness of these first 2 methods. They do not use present value concepts, which are relevant, very relevant. The first, average rate of return, we're going to see is the weakest method. Cash payback, we're going to see is a simple method, very simple to calculate. It's used more often, as we can see down here. The next 2 are methods that use present value concepts, which is an advantage of them. The net present value, which the world of finance believes is the best method. Everyone from Warren Buffett to finance PhDs believe that this is the best method for evaluating it. A project's value is equal to the discount and cash flow of all its future cash flows effectively. The internal rate of return, we're going to see its definition is based on the net present value method anyway, so these are 2 very interrelated concepts. These 2 methods recognize the time value of money. Time value of money simply states that money, that $1 today is worth more than $1 tomorrow because we can earn interest on the dollar today. Alright, let's see what's popular. Let's see what managers are actually using. We see average rate of returns the weakest. Cash payback has a pretty strong representation with 53%. Notice this adds up more than 1 because oftentimes they use more than 1 approach. Net present value, as we would expect, as the highest here, and then internal rate of return is in second place right behind it. Alright, the average rate of return, we had the formulas here. I'm not a fan of this method. You can ignore this part if you want. We can look at the weaknesses. It doesn't consider the timing of the cash flows. It doesn't have net present value concepts in it, or the time value of money concepts in it, which makes it very weak. It's producing an output of a percentage too. It might be misinterpreted. It's not very popular. So we're going to move on to the cash payback method. Alright, so we're just cash payback. We're measuring when we get our initial investment back, right? To start a project or an investment, we have to pay out cash to buy a fixed asset or to start a new project. This is just going to measure over time that project should generate cash for us. When do we get our initial cash investment back? Now, if the cash flows are equal, then we can use this formula. Cash payback period is equal to the initial cost divided by the annual net cash inflow for a project. And we're going to see an example of this. So to illustrate, the management is considering the purchase of the following project. The cost of this machine is $200,000. The revenues from the machine per year are $50,000. The expenses from it, including depreciation, are $30,000. Depreciation itself is $20,000. So they're trying to trick you here with the depreciation. In this chapter, we're focused on cash. On all these methods, the value of something is, we're focused on the cash, not the net income side of it. So we really want to back this out. Depreciation is a non-cash expense. So while it reduces net income, it doesn't require cash payment. So we're going to take this out of the 30 effectively and arrive at 10. The actual cash expenses per year are $10,000. So we're going to assume this is the cash revenue and the cash expenses will be 10. So we're going to take the revenue of $50,000 minus the cash expenses of only $10,000, right? Because we take out the depreciation, and we get our net cash inflow of $40,000 per year. Oh, they're showing you they're taking out the depreciation here to get to the 10. So now all we need to do is take that initial investment, the $200,000, and divide it by the $40,000 we expect to get per year. And do the math, you get 5 years. So the cash payback period for this project would be 5 years. That's how long it would take us to get our initial cash outlay of $200,000 back. Alright, the cash payback method continued here. This time we're going to look at one that has uneven cash flow. So notice these numbers aren't the same. Has an initial cash outlay of $400,000. What we need to do is keep adding these together until we get to $400,000. So the first one, after year 1, you had $60,000. That's a total of $60,000. Next year we had $80,000. So $60,000 plus $80,000 equals $140,000. The next year we have $105,000. So $140,000 plus $105,000 equals $245,000. We're not at $400,000 yet. We need to keep going. This number plus $155,000 equals $400,000. We're done actually right here. We wouldn't really need to continue the math down here. They did in this image, but we're really done right here. Our answer isn't $400,000 though. Our answer is 4. That's how many years it takes to get our cash back. You can see a graphic here. It's just showing you when they get the cash back effectively right here when the two equal. Alright, it's very simple to use. That's why it still remains popular. It analyzes cash flow, which is very important. When we get our cash back, we're free to invest that in another project. It ignores cash flows occurring after the payback period. Remember I said we didn't even do the math here to solve it, so it completely ignored these cash flows. And it does not use present value. We didn't use present value concepts at all here. So moving on to the next section, we're going to introduce present value concepts. So the timing of the cash flow is very important in determining the value of a project, not just how much cash it produces over time, but the timing of those cash flows, because there is such thing as a time value of money. Alright, so two methods: net present value, internal rate of return. Both of these use present value concepts. We're going to look at two different types of present value concepts, one for a single amount and then one for an annuity. Annuity is multiple equal payments, a series of equal payments over equal time periods. If you have a car payment you pay every month, that's an annuity. If you pay rent every month, that's an annuity. So there's a lot of examples of annuities that we pay. If you have a gym membership, $35 a month, that's an annuity. If you have a cell phone, another annuity. So annuities are all over in our society. Alright, present value of an amount. So it says if you were given a choice, would you prefer $1 now or $1 3 years from now? Well, you'd want the $1 now because you can invest it. And they're starting off with this lovely figure of $1. They're going to invest it for 3 years at an interest rate of 12%. So we start off here at $1. It's going to earn 12% after 1 year. So if we skip forward 1 year, it'd be $1 times 1.12. And now we have $1.12. The next year we have $1.12. We multiply that by 1. This one represents the interest rate, the 12% interest rate. Multiply it by 1.12 and we have 1.254. At this point the interest is earning interest. That 12 cents of interest that we earned for the prior period is starting to earn interest. This effect is called compounding. Now we're at $1.25 or so, and we multiply that by the 12%. We'll use the 1 in that formula to keep the base there. So, and then we're at $1.40 and 4 fractions of a cent. Alright, so we're at $1.40. Alright, now what they're going to do is they're going to take this back in time. This is 3 years in the future. We're going to take it back in time using the present value tables, and we'll show you effectively how they work. And that's why I used to call these time machines. And if you saw the one in Principles 1 what I did, I called these a time machine. Because effectively we're going to take this dollar figure back in time, not by undoing this math, but by using a table. And we're going to see that we're going to get back to $1. Alright, so this is in 3 years at 12%. They have it highlighted. We're going to multiply the cash flow by this value. So the ending cash flow by that value, this was going to convert it back in time. Notice we're going back in time now. If you do this math, you can verify it equals $1. So this is a time machine. It's going to take future cash flows and convert them to their present value equivalent. This is present value of $1. It does it for a single amount. Where if we get to the other one, present value of an annuity, it does it for multiple payments. So an annuity is a series of equal cash flows at fixed time intervals. Very common to see. Present value of an annuity is the amount of cash needed today to yield a series of equal net cash flows at fixed time intervals in the future. Alright, so let's take an example. $100, 5 years, 12%. Alright, so what we could do, we don't need this other table that I'm about to show you. What we could do is think about this $100 occurring every year for 5 years. We go back to the previous table, and this is under 12%. Go back to the previous table. We're going to multiply the first one because we need to take it back one period, the second one by that one, third one by that one, the fourth one by that one, the fifth one by that one, which is useful because sometimes we can't define things as annuity whenever we get into net present value. This is an annuity because they're equal. Sometimes these cash flows aren't equal, and if they're not equal, it's not an annuity, and we're going to have to do math like this approach. That's what they're doing here. They're taking the $100 times those values that we found under 12%, the first 5. You're getting the present value of each single amount, and then you add the amounts together, and you get to 360.5. Now what you could do, you could define this as an annuity and use the present value of an annuity table. 5 periods, 12% is this one that's highlighted. We could just take $100 by times 3.605, one calculation instead of what 5 different ones here plus adding them together, 6 different calculations. All you need is one. So you can just do this math right here instead of doing all this math using this table. So that's really the power of it. But you want to tell the difference between them. One quick way to look at it is this one has numbers greater than 1. Has numbers greater than 1. The cash flows are still being discounted. Notice this number isn't 4. You just have multiple ones. You have multiple payments, one for each period. Alright, now let's get to the net present value method. It's also sometimes called the discounted cash flow method. Alright, we need an interest rate in here. It's sometimes called the hurdle rate. We'll see how to interpret this interest rate towards the end too. Alright, so an example here, we have a cost of new equipment of $200,000, expected useful life of 5 years, the minimum desired rate of return is 10%, and then we have expected cash flows here. These cash flows, as you see, are uneven, so therefore we can't define this as an annuity. We're going to have to use the table, the present value of $1 table, to discount each one of these cash flows. But it's going to produce a total of $260,000. So it costs $200,000 in cash. It produces $260,000 in cash. So isn't it earning us $60,000 over time in cash? Yes, it will earn us $60,000, but that's not its value it's going to add to our firm because these cash flows are out in the future. Because they're out in the future, they're not really worth that much. This $70,000 isn't worth quite $70,000 because we're not going to get it for a year. $60,000 is not worth $60,000 because we're not getting it for 2 years, and so on and so forth. So what we're going to do is take these cash flows and multiply them, go back to the present value of $1 table, look under 10%, and multiply them by the values under that table. So we're going to multiply the first one by 0.909, the second one by this one, third one by that one, the fourth one by that one, and the fifth one by that one. Alright, so if we go back down to it, that's what we've done here. So we're taking these cash flows times these values that we got from the present value of $1 table. We multiply them across. We get to all these figures. What we're going to do now is add them together. We'll get the total value of $202,900. The last step here, and why it's called the net present value method. Net means you're deducting something, right? Always like your net pay is different than your gross pay. Alright, so we're going to deduct the initial investment of $200,000. So it'll be $202,900 minus $200,000. And you get to an amount of $2,900. So this project will still make us money. It'll still add value to the firm, but it's not going to add $60,000 of value. It's only going to add $2,900 of value. The other conclusion we can get here is that the hurdle rate was 10%. Since this is producing a positive net present value, we conclude that that this project is earning more than 10%, right? Because this value produced a positive number here. If it produced a number 0, then this number would be called its internal rate of return, but this isn't the internal rate of return. That number isn't 0. If this number was negative, we can conclude that it didn't meet this standard. That's why it's called a hurdle rate. It's because if it meets that standard, if it's a positive NPV project, it's above the interest rate that was used to calculate it. Alright, net present value, the other way you can imagine this, or how you want to imagine it in your mind, is these cash flows being brought back in time. This is exactly the same math. It gets you the exact same figure, just a conceptual way. These cash flows are out in the future. We drag them back in time using the present value tables for $1. And notice the 200,000 is a negative. It's already at the right time period. We got to pay that today, so we don't need to discount it at all. Yeah, so it's providing more than the minimum rate of return of 10%. Yeah, and it's desirable. Positive MPP. The general rule is if it's positive, you accept it. If it's negative, you reject it. It wouldn't. Negative one will destroy value of the firm. Positive one will add value. All right, it has these advantages. It considers the cash flows of the investment. Okay. It considers time value of money, which is very important. They have two disadvantages. One is complicated. It's really not that complicated. I guess I gotta say something. It assumes the cash flows can be reinvested at the minimum desired rate of return, which may not be the case. So yeah, that is one of the flaws of it. It's assuming that when we get these cash flows, we're going to be able to earn that 10% on them. Alright, the internal rate of return method. The internal rate of return uses present value concepts, so we like it for that reason. I've never heard it called that. Alright, let's take an example. We have a cost of new equipment of $33,530, yearly expected cash flows to be received of $10,000, expected life of 5 years, minimum rate of return of 12%. What we could do to solve IRR, IRR is the discount rate that makes net present value equal to 0. So what we can do is run this analysis and see what the net present value is. In this case, the net present value is $2,520, but it's positive. That means that this project is earning more than 12%. So our next step would be to bump this up. We could bump it up to 13, run this analysis again. If it's still positive, we'd increase it again. But that's the trial and error part of IRR. There's not like a math formula that you can do. You just plug in a value. If this is positive, you increase it. You keep increasing it until we can get this number to be 0. And luckily the book's already done it for us. As you see here, they found the magic rate right here. So the rate that makes this net present value equal to 0, notice it's 0. We wanted a value right here that canceled out this negative cash flow exactly right and produces a net present value of 0. And we manipulate the interest rate to do that. We kept increasing this one to 15, and then we got it to work. We produced a 0 net present value. But this is really a trial and error process. That's why computer programs are great at it. I just want you to conceptually understand. And the answer to this question is 15%. That is this project's internal rate of return. So it gives you an output as an interest rate, where net present value gives you a dollar figure output. So advantages, it considers the cash flows. Okay, it considers time value of money. That's a big one that we like. Okay, even if their lives are not the same, it's going to give us an interest rate, which makes it comparable. Complex calculations, yeah, it usually requires a computer. Yeah, and also just like net present value assumes that the cash received can be reinvested at the internal rate of return, which may not be a valid assumption. But those are the 4 methods throughout this chapter. That's it for this video. We kept this one nice and short. We'll see you guys next time for the next video. Alright, bye-bye.